Welcome back to our channel, where we simplify complex financial concepts and make them accessible for beginners. In today's video, we will demystify systematic risk and provide you with a comprehensive understanding of this important concept. Whether you're new to investing or looking to deepen your knowledge, this video is for you. Let's dive in. Systematic risk, also known as market risk, is a fundamental concept in finance that every investor should be aware of. It refers to the risk that is inherent in the entire market or a specific segment of it and cannot be eliminated through diversification. Understanding systematic risk is crucial because it helps investors assess and manage their overall portfolio risk. Let's explore some key aspects of systematic risk. 1. Definition and examples. Systematic risk is the risk that arises from macroeconomic factors, such as economic conditions, interest rates, inflation, geopolitical events, and market volatility. It affects the entire market or a particular sector, impacting the majority of securities within that market. Examples of systematic risk include recessions, political instability, natural disasters, and changes in consumer sentiment. 2. Non-diversifiable risk. Unlike unsystematic or specific risk, which can be reduced through diversification, systematic risk cannot be eliminated by diversifying your portfolio. This is because it is inherent to the market as a whole and affects all investments to some degree. Therefore, when assessing your portfolio's risk, it's important to understand that systematic risk cannot be diversified away. 3. Impact on investments. Systematic risk has a direct impact on the returns of investments. During periods of increased systematic risk, the overall market or specific sectors may experience declines, resulting in negative returns for many investments. Conversely, during periods of lower systematic risk, the market or sectors may perform well, leading to positive returns. 4. Risk management strategies. As an investor, it's important to be aware of systematic risk and incorporate risk management strategies into your investment approach. These strategies may include diversifying across different asset classes, considering the correlation between investments, and aligning your portfolio with your risk tolerance and investment goals. 5. Systematic risk factors. Systematic risk can be influenced by various factors, including economic indicators, monetary policy decisions, technological advancements, political events, and market sentiment. Staying informed about these factors and their potential impact on the market can help you make more informed investment decisions. Systematic risk is a critical concept to understand when building and managing your investment portfolio. By recognizing that it cannot be eliminated through diversification, investors can take steps to manage their exposure to systematic risk and make informed decisions based on their risk tolerance and investment goals. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more valuable content on finance and investing for beginners. Thanks for watching. Please subscribe to our channel.